What's happening Tuesday, the 19th of December? I had videos done last week. They just got stuck on my outbox, sending my team to be able to edit and send out to you. So that's why you hadn't heard from me. It wasn't a matter of me not doing them. It's just a matter of me not sending them out. So I'll try and see if I can catch us up here. Credit news, something that I saw recently talked about the affordability of housing is the worst it's been since 1981. So I had to go look. What was the median price of housing in 1981? $68,900. Income in 1981, yeah, it was fairly low compared to where we are today, but the cost of goods, period, was so much lower, ridiculously lower. If you want to see a difference, we were watching Christmas Vacation this weekend. Me and my kids, I was out in Missouri hanging out with my son and his daughter, my sister, her family, my mom, and in that you'll see while they're going to the store. Cousin Eddie, and he's grabbing the bags of dog food and throwing it in the cart. Look at the prices on that. It is ridiculously different. What would be like 20, 30, $40 today is like $5 back then. Go take a look at that. You see how inflation has impacted. And that was early 90s. 1980s is much, much lower. So if you had a median price point of 68,000, sure, the wages may have been a lot lower, but comparatively speaking, the wages were way better than where they are today. So of course, affordability is off. Affordability is way off. What does that mean for you as a real estate investor? If you can get single family residences, you will have people that will need to rent them because affordability is so far off of what's possible for them to be able to buy and own a home. What are the other things that are out there I thought was interesting? A pound of ground beef now costs $5.23. January of 2020 is $3.89. That's up 14%. Prices for fruits and vegetables are up 14%. Start doing the math on that beef situation. You start seeing exactly where things are going. There's another bill introduced to the Senate again about trying to stop hedge funds from getting homes. I talked about one in the past, right? Is the Stop Predatory Investment Act that was put together by a group of senators, went nowhere. I'm with the team that goes and researches these and digs into them, trying to understand what the deal is with them. That went nowhere. It was more, I guess, penned to say, hey, look what we're trying to do over here. Nobody's doing anything. When you actually look at the depth of those bills, it was actually helping the hedge funds to own more. Those guys own or control way too much. I don't have faith in the people right now that are writing bills, that they're going to write them to the benefit of us. It's just not happening that way. If bills want to be written to the benefit of us, the people, better be 10 pages long and that's it. And they better be in the kind of language that a middle schooler or junior high student can read and understand. This stuff that there are thousands of pages, you and I both know that's all complete bullshit. And they're putting something together in there to accomplish what they're saying they're trying to combat. So I don't give that a whole lot of value. We're going to continue to keep pushing on it though. If that does start to get some legs, we want to look at it and see exactly what the depth is, and I'll let you know what that looks like. So where we're at right now, Fed comments last week, a lot of people are saying, well, the Fed said they're going to start cutting rates. That probably may not happen until the first, maybe second quarter of next year. There's a lot of speculation of how much those rates are going to be cut. There is several different members of the Fed, three of them that I have directly in front of me that have said, hey, don't get too eager about what the potential is here. They want to really be sure that the economy settled in before they start doing any of that cutting. You cut too early, it could freak out the market. Plus, people are spending the money way more than they should be given the current condition of their savings and their income. So when you stack all that up, I don't know if we're going to see those cuts that everybody thinks we're going to see as fast or as quickly as they're coming. Too much speculation in the market. So another thing that we're looking at here is how the mortgage-backed securities have responded. I'm going to show you these charts. Now, we had that whole downward channel that we talked about, went all the way down to where it bottomed out here. We had this massive run up because of what was happening with jobs reports, all of these things that they used to cook, really make it look better than it really was. Remember, I commented on this over and over and over again. The headline number for jobs made it look like jobs were being created. Then they would do the revised number later, and they put it in the back of the news, the back of the newspaper, if you will, if you're looking at it from a physical perspective, showing, oh, sorry, we revised it down, showing, yeah, we really didn't create that many jobs. A lot of cooking of the books made it look like jobs were getting better when they really were not. Because of that, under that information starting to finally come out, just this in the last couple of months saying, okay, jobs are not as good as we said they were. We're not, they're starting to show that back in late October, early November, jobs are really kind of a lot rougher than what we've been claiming. Then everything started to rally. We jumped, what is this, 500? So actually, it's been from the bottom here, 93.62 to over 100. Guys, that's over 600 basis points that it moved that fast and that rapidly, but look where it stopped. Here's the thing that I find interesting. It ran hard. It blew through all these resistance lines. It blew through all the moving averages, even through the 200-day moving average, which the 200-day has been just a formidable force all along. Blew through that, but where did it stop? If you go all the way back to anything I've been talking about, this yellow line here represents the day they announced quantitative easing in 2008, November 25th, 2008, when the Fed said we're going to do quantitative easing. We're going to take U.S. Treasury capital, run it through the Federal Reserve, and buy mortgage-backed securities and treasuries and all that to stimulate the economy. That right there represents the day the Fed said that they're going to use U.S. capital to influence the market. Before that, all the trading was below that line. I mean, it'd come above it a little bit, but for the most part, stay below that line. That's where we hit, and that's where we pulled back from right there. So we got this little support here. I think we're going to be bouncing sideways. I would be interested to see if we can blast through that. That seems like a very, very, very strong resistance point. But here's the other thing. We've got support here, support at the 200-day moving average, but it's a long fall to the 200-day moving average. If we break through this, that's a pretty long fall to that 200-day, and that is going to be a lot of, what are we looking at here? So 100.18 down to, that's a 200 basis point move. That's a pretty significant amount of move. So something to be aware of, and start, if people are telling you rates are going to keep getting better, I can't say that they will. To me, the rates are where they should be. We had that real ugliness going, and in reality, it really ended up where I thought it would end up, which was double digits. If you took away, because we are charging points all the way to the peak, right? We've been charging points all along in the real estate investment world. If we went with a 0-point loan for a real estate investor, I think we'd have been close to breaking 10%. That's why you never saw a 0-point loan. There's always points being charged to keep you lower, so that when the time comes to refinance, things get lower. You don't want to refinance because you've already paid for the rate. So if you need more detail on that, get in touch with me. We're going to keep watching this. I think we're at a really, really good spot. Pull locks, keep things moving along. If you have questions about the economy, questions about how you should be operating as a real estate investor in today's environment, get a hold of us. We've got deals we're working all over the country. Watch your emails. We've got stuff that we're trying to get out to you to give you a lot more cash flow capability. We're partnering with a lot of great teams out there. So watch for it. Call us if you want to know more about those teams and the cash flow capabilities we're able to get for you. We'll talk to you real soon.